Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
The small speculators sometimes get stubborn when they're in a trade, and so therefore they're less likely to they generally join the party too late. They're at the end run of a trend, and generally they're the ones who say, gee, I'm not wrong, the market's wrong, I'm sure it'll come back. And so as the market starts to move against them, that's when they finally pitch it in. So the point is that I would suspect that we're coming up to a potential reversal. So for me, the logic is I like to examine, in order to see where a market might go, I first have to see and understand where has the market been. And so that is one of the key elements to uncovering when a market will roll over. So the key is to spot subtle changes in the ebb and flow of the market's moves, something that gives us a hint that we're starting to see unwinding of positions. So how can we identify momentum loss in the marketplace? Well, we can optimize moving average settings. We have at our disposal transparent and equal opportunity access to digest and use the high, the low, the open, and close, our guide to identifying trading opportunities. Most traders simply rely on simple moving averages based on the close, and as well as a tool known as Bollinger Bands. There are also oscillators and indicators, and the more popular ones, even CCI, stochastics, MACD, RSI, and percent R, Williams. That was developed by Larry Williams, percent R. Now I'm going to show you in this presentation a couple indicators, but first I want to go through the candle patterns and what I define by looking at candle patterns, what the significance of pure price action that can help us to uncover when a market is starting to back off. And you're going to get, by looking at pure price action, an earlier warning signal than you would with an indicator. And I'll tell you right now, we'll talk about, and I'll just tell you right now, most people look at the default settings of, say, MACD, M-A-C-D, of a 12, 26, 9 exponential moving average parameter. If you think about what I've just said, 12, 26, 9, none of those are current bars. They're delayed. It's lagging. Same thing with stochastics. Stochastics, even if you use a fast stochastics is less smooth than slow, but why would I want to use a slow stochastics? I don't need indicators that are slower than they already are. I want current ideas of when there's momentum change in the market. I don't want lagging indicators on this. I don't want to be the last guy out of the building. I want to be the first top 10% of the people taking profits on a marketplace. So if I'm anticipating there's a reversal coming in the market, what indicators are out there that can help me? Well, first off, just by examining pure price action, that's one of them. And we could look at, as the slide to our left shows, that a positive candle is hollow. We will see, or in charting, you'll see a green colored candle, that the close is greater than the open. In more bullish condition, we will see not only the close greater than the open, but we're going to see the close closer, or it maintains to its highs. And that shows that there's more significant strength in the market condition right now. Chart on your right is the opposite. It shows that the close is less than the open. There, and you can notice that with candle patterns at least, you can see immediate results of where is the close as it relates to the overall range. Is the close closer to the high in this case? No, it's closer to the low. So therefore, we see more bearish conditions, especially when the close is less than the open and if the close is closer to the low. Now, there's a little bit more to candlestick analysis, but by essence, if we're in an uptrend and we start to see the distance of the open close, which we call the real body, if we start to see those start to diminish and we start to see those change from green to red, if we start to see long-range moves start to compact, we start to see, it shows us that there's possibly indecision coming in the marketplace and that we could be coming close to the crossroads of a market reversal. So once again, the candlestick characteristics, we want to look at it's important to learn what the relationship is between the open and the close, and we call that the real body, and what the real body's colors mean, what the significance is, what the shadows and the correlations to the overall candle body, and what the size of the shadows are. These are the things that we like to absolutely instruct people, traders, to identify correctly. Candles give us immediate identification of a market's current environment and the market participants' acceptance or rejection of a support or resistance level in a clear visual manner. Now, the lessons that we're giving right now are going to make a lot of sense, especially when we get to our charting application. But one of the things that we've done that I wrote about and discussed and put in and was published in a work with John Wiley and Sons was the frequency of certain candle patterns. And I'd like to share with you, if I haven't done this in past sessions, is with the euro in particular, there's a lot of times that these candles form and give us frequent triggers or significant clues as to market reversal and turns. Now, based on, and this is important, based on a 15-minute time frame, so for intraday trading, this is powerful information. 22% of the time, the low of the day in a euro currency was formed by a doji, but 41% of the time it was formed by a hammer. The lows of the day were formed more times than not by hammers. If you just focused on dojis and hammers, almost 64% of the time you have an idea of what the internal or intraday low might be. That's powerful inside information, or at least gives you an additional edge from a probability standpoint. As far as a high is concerned, only 18% was formed by a doji. 41%, the same statistical value, was formed by a shooting star. So it's important to look at candles and what creates their formation. A shooting star, for example, the market has a small-ranged real body, meaning the open-close relationship. The close is closer to the low, and it has a long shadow, or the market has backed off the high significantly. And we'll show you that in just a minute. So there are ways that you can beat out indicators that can give you early warning detection. And indicators can also help give you an idea of when the momentum is starting to fade. Now, in this graph, you're looking at a euro currency, and you can see that we get these hammers. These are the hammer patterns that we're looking for that can nail down bottoms. And as you go through and understand charting, I thought I'd like to show you an actual chart of the euro currency many people may not be familiar with, but this was back in 2001 when the euro currency, after it first opened up, it actually had traded lower against the U.S. dollar, and the actual lows were formed by hammers. These are end-of-day charts. Now, this is not the ISE's Euro index. This is the actual euro currency. I wanted to go back in time and show you where has the euro been versus the U.S. dollar, and we've seen it actually from these levels almost nearly double in just 9 trading years. Remember, last year, the year before, we were up close to 160 in the euro currency. So quite frankly, it has had significant moves with the U.S. dollar, which, due to that volatility, presents traders with enormous opportunities, and especially since the ISE has options on these indexes, it really can give us just all types of available trading setups. The important thing is to identify which way is the market going to go. So if we can identify certain candle patterns and certain indicators, kind of put it together, we can kind of increase the probabilities of success, or at least reduce the chance of significant loss. And that's the key of being successful in trading. It's not hitting for the fences every single trade. It's not hitting the ball out of the park every single day. That's nice, believe me. But the reality is you're going to have losers in this business, and you want to be able to be a successful loser when it comes to trading. End of story.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.